Introduction to Self-Storage Investing. Self-storage facilities represent a unique and often resilient sector within commercial real estate, offering investors a compelling alternative to traditional asset classes. This industry provides space for individuals and businesses to store their belongings, driven by various life events such as moving, downsizing, or business inventory management. Understanding the fundamental appeal of self-storage is the first step towards recognizing its investment potential. Its demand is generally stable, even during economic fluctuations, as storage needs persist across different market conditions. This course will delve into the intricacies of this market, providing a solid foundation for aspiring and experienced investors alike. Investing in self-storage facilities involves acquiring, developing, or managing properties where tenants rent individual storage units. These properties typically feature a range of unit sizes, climate control options, and security measures to cater to diverse customer needs. The business model is characterized by high operating margins and relatively low maintenance costs compared to other real estate types, making it attractive to many investors. Furthermore, the fragmented nature of the market often presents opportunities for consolidation and value-add strategies. We will explore how to identify these opportunities and capitalize on them effectively throughout this program. Why invest in self-storage? Self-storage offers several compelling advantages that make it an attractive investment vehicle for many. One significant benefit is its recession-resistant nature. Demand often remains stable or even increases during economic downturns as people downsize or businesses adjust operations. This resilience provides a level of stability not always found in other commercial real estate sectors. Additionally, self-storage typically involves lower operating expenses compared to residential or retail properties, as tenant turnover costs are minimal and maintenance requirements are generally less intensive. The simple business model also means fewer landlord-tenant issues, streamlining operations considerably. This combination of stability and efficiency contributes to strong cash flow potential. Another key advantage is the flexibility of lease terms, predominantly month-to-month, which allows for dynamic pricing adjustments based on market demand. This adaptability enables owners to quickly react to market changes, optimizing revenue streams. The industry also benefits from a relatively low barrier to entry for smaller investors, with opportunities ranging from acquiring existing facilities to developing new ones. Furthermore, self-storage properties often require less intensive management than other real estate types, making them suitable for both active and passive investors. The potential for value-add strategies, such as implementing technology upgrades or expanding existing facilities, further enhances investment returns. Market trends and demographics. Understanding current market trends and demographic shifts is crucial for successful self-storage investing. Population growth, particularly in suburban and exurban areas, directly correlates with increased demand for storage solutions. Lifestyle changes, such as the rise of smaller living spaces and increased mobility, also contribute significantly to this demand. Furthermore, the growing number of small businesses and e-commerce ventures often require flexible storage for inventory and equipment, creating a robust commercial tenant base. Analyzing these macro trends helps investors identify promising markets and anticipate future demand. Keeping abreast of these shifts allows for strategic positioning and maximizes potential returns. Demographic analysis involves examining factors like age distribution, household income levels, and migration patterns within a target market. For instance, an aging population may require storage for downsizing, while younger generations in urban centers often need space due to smaller apartments. Economic indicators, including employment rates and housing market activity, also play a vital role in assessing market health. A strong housing market with high turnover often boosts storage demand. Investors should look for areas with consistent population growth, diverse economic bases, and a favorable supply-demand balance to ensure long-term viability. This detailed approach helps mitigate risks and uncover hidden opportunities. Types of self-storage facilities. Self-storage facilities come in various forms, each with distinct characteristics and investment profiles. Traditional drive-up units are the most common, offering convenient access directly from a vehicle, often preferred by those needing frequent access or storing large items. Climate-controlled units provide regulated temperature and humidity, essential for sensitive items like electronics, documents, or antique furniture, and typically command higher rental rates. These units are often found in multi-story buildings, maximizing land use in denser areas. Understanding these basic types is crucial for matching a facility to a specific market demand. Each type caters to different tenant needs and offers varying operational complexities. Beyond traditional and climate-controlled, there are specialized facilities such as boat and RV storage, which cater to recreational vehicle owners, often located near lakes or popular travel routes. Portable storage containers, delivered to a customer's location, offer flexibility, but operate under a different logistical model. Hybrid facilities combine multiple types, offering a broader range of services to attract a wider customer base. Each type requires a different investment strategy, from land acquisition and development costs to marketing and operational considerations. Investors must carefully assess the local market to determine which facility type will yield the best returns and meet community needs effectively. Understanding the business model. The self-storage business model is relatively straightforward, focusing on renting space to tenants on a month-to-month basis. Revenue is primarily generated from rental fees, with additional income often derived from ancillary services, such as selling packing supplies, offering insurance, or charging administrative fees. Operating expenses typically include property taxes, insurance, utilities, marketing, and management salaries. Unlike other real estate ventures, self-storage often has lower tenant improvement costs and minimal vacancy turnover expenses. This lean operational structure contributes to higher net operating incomes and attractive profit margins. Understanding these core revenue and expense drivers is fundamental to evaluating a facility's financial health. Key aspects of the business model also involve effective property management, which encompasses marketing, tenant acquisition, rent collection, and facility maintenance. Technology plays an increasingly important role, with online booking systems, automated gate access, and remote monitoring becoming standard. The ability to manage a diverse tenant base, from individuals to small businesses, requires flexible pricing strategies and excellent customer service. Successful investors focus on optimizing occupancy rates while maximizing rental income per square foot. This balance ensures sustained profitability and long-term asset appreciation. The simplicity of the model, combined with its high demand, makes it appealing. Key Performance Indicators (KPIs). Monitoring key performance indicators (KPIs) is essential for assessing the health and profitability of a self-storage investment. Occupancy rate, which measures the percentage of rented units, is a primary KPI, indicating demand and operational efficiency. Net operating income (NOI) reflects the property's profitability before debt service and taxes, offering a clear picture of its core financial performance. Revenue per available square foot (RevPAS) is another critical metric, helping investors understand how effectively they are monetizing their available space. These indicators provide a snapshot of current performance and help identify areas for improvement. Consistent tracking allows for informed decision-making and strategic adjustments. Other important KPIs include average rental rate per unit, which tracks pricing effectiveness, and tenant turnover rate, which highlights customer satisfaction, and operational costs associated with unit preparation. Delinquency rates are also vital, indicating the percentage of tenants who are behind on payments and impacting cash flow. Understanding the cost per acquisition of new tenants helps evaluate marketing effectiveness. By regularly analyzing these metrics, investors can benchmark their facility's performance against industry averages, identify trends, and implement strategies to enhance profitability and asset value. A holistic view of these KPIs is crucial for long-term success. Due diligence, location analysis. Thorough location analysis is paramount in self-storage investing, as the success of a facility is heavily dependent on its accessibility and visibility. Investors must evaluate factors such as traffic counts, proximity to residential areas, and ease of access from major roads. A site with high visibility and convenient ingress-egress will naturally attract more tenants. Understanding the local competitive landscape is also critical. Assessing the number of existing facilities, their occupancy rates, and their pricing structures. Oversaturated markets can lead to lower rental rates and higher vacancy, while underserved areas present significant opportunities. This detailed assessment helps identify optimal sites for acquisition or development. Beyond immediate visibility, a comprehensive location analysis includes examining local zoning regulations and future development plans. Zoning restrictions can dictate what types of facilities can be built and their maximum size, impacting potential expansion. Future infrastructure projects, such as new housing developments or road extensions, can significantly alter demand and accessibility. Demographic trends, as discussed earlier, also play a crucial role in determining the long-term viability of a location. By combining these elements, investors can make informed decisions about whether a specific site aligns with their investment goals and market potential. This meticulous approach minimizes risks. Due diligence, financial review. A rigorous financial review is an indispensable part of due diligence when investing in self-storage. This process involves scrutinizing the facility's historical financial statements, including income and expense reports, rent rolls, and occupancy trends. Investors must verify all revenue streams, such as rental income, late fees, and ancillary sales, against actual bank deposits and operational records. Equally important is a detailed examination of operating expenses, ensuring all costs are accounted for and that there are no hidden liabilities. This deep dive into financial data helps to confirm the property's profitability and identify any discrepancies or red flags. It is crucial for accurate valuation and risk assessment. Beyond historical data, the financial review should include an analysis of the facility's pricing strategy and its potential for revenue growth. This involves comparing current rental rates to market averages and identifying opportunities for rate increases or the introduction of new services. Investors should also project future cash flows, considering potential capital expenditures for maintenance or upgrades. Understanding the property's debt structure, if any, including interest rates and repayment terms, is also vital. A comprehensive financial review provides a realistic picture of the investment's potential returns and helps in negotiating a fair purchase price. This thorough approach safeguards against unforeseen financial challenges. Property valuation methods. Accurately valuing a self-storage facility is a critical step in the investment process, requiring the application of specific real estate valuation methods. The income capitalization approach is widely used, which converts the property's net operating income, NOI, into a value estimate by applying a market-derived capitalization rate, cap rate. This method is particularly relevant for income-generating properties like self-storage, as it directly reflects the property's earning potential. Understanding how to calculate and apply cap rates, which vary by market and property type, is essential for arriving at a realistic valuation. This approach provides a clear financial perspective on the asset's worth. Another common method is the sales comparison approach, where the value of the subject property is estimated by comparing it to recently sold similar properties in the same market. Adjustments are made for differences in size, age, condition, location, and amenities. While useful, finding truly comparable self-storage sales can sometimes be challenging due to the unique nature of each facility. The cost approach, which estimates the cost to replace the facility new, less depreciation, is often used for newer properties or for cross-checking other methods. Combining these valuation techniques provides a more robust and reliable assessment of a self-storage facility's market value, ensuring a well-informed investment decision. Financing options for self-storage. Securing appropriate financing is a critical step in acquiring or developing a self-storage facility. Traditional bank loans, often commercial mortgages, are a common option, typically requiring a substantial down payment and offering competitive interest rates. These loans are usually tailored for income-producing properties and require a strong financial history from the borrower. Small Business Administration (SBA) loans, such as the SBA 7A or SBA 504 programs, can be excellent alternatives, especially for smaller facilities or owner-operators, as they often feature lower down payments and longer repayment terms. Understanding the specific requirements and benefits of each loan type is crucial for making an informed decision. Each option presents unique advantages and disadvantages. Beyond traditional and government-backed loans, investors can explore other financing avenues. Private equity and syndication allow multiple investors to pool capital, often for larger projects, offering a way to acquire properties without sole reliance on debt. Seller financing, where the current owner provides a loan to the buyer, can be a flexible option, particularly in niche markets. Mezzanine debt and preferred equity are more complex, higher risk, higher return options typically used for development or value-add projects. The choice of financing depends on the investor's financial situation, risk tolerance, and the specific characteristics of the self-storage project. Diversifying financing sources can also mitigate risk. Acquisition strategies. Developing a clear acquisition strategy is fundamental for successful self-storage investing. Investors can pursue various approaches, including direct purchase of existing facilities, which offers immediate cash flow and established operations. This strategy requires thorough due diligence to assess the property's current performance and identify any deferred maintenance or operational inefficiencies. Another approach is acquiring underperforming assets with the intent to implement value-add strategies, such as improving management, increasing rental rates, or upgrading amenities. This often requires more capital and expertise, but can yield higher returns. Each strategy demands a different level of commitment and risk tolerance. Alternatively, investors might consider ground-up development, which involves purchasing raw land and constructing a new facility. This strategy offers the highest potential for customization and modern design, but also carries greater risks, including zoning challenges, construction delays, and market absorption uncertainties. Another option is converting existing properties, such as abandoned retail stores or warehouses, into self-storage facilities. This can be cost-effective but requires careful structural assessment and adherence to conversion regulations. The choice of acquisition strategy should align with the investor's experience, capital availability, and long-term investment goals. A well-defined strategy is crucial for navigating the competitive market. Property management essentials. Effective property management is the backbone of a successful self-storage investment, directly impacting profitability and tenant satisfaction. Key responsibilities include marketing vacant units, screening tenants, managing lease agreements, and ensuring timely rent collection. A well-organized system for tracking payments and addressing delinquencies is crucial for maintaining consistent cash flow. Furthermore, providing excellent customer service is paramount, as positive tenant experiences lead to higher retention rates and positive word-of-mouth referrals. Efficient management minimizes operational headaches and maximizes the asset's value. It requires a blend of administrative skills and customer-centric approaches. Beyond administrative tasks, property management also encompasses facility maintenance and security. Regular upkeep of the grounds, buildings, and individual units is essential to preserve the property's appearance and functionality. Implementing robust security measures, such as surveillance cameras, automated gate access, and individual unit alarms, provides peace of mind for tenants and protects their belongings. Technology plays a significant role in modern property management, with software solutions streamlining tasks like online bookings, payment processing, and remote monitoring. When hiring a third-party management company or self-managing, A clear understanding of these essentials is vital for operational excellence and long-term investment success. Marketing and occupancy strategies. Effective marketing is crucial for achieving high occupancy rates and maximizing revenue in the self-storage industry. A multi-channel approach is often most successful, combining online and offline strategies. Digital marketing, including search engine optimization, SEO, pay-per-click, PPC advertising, and social media engagement, helps facilities reach a broad online audience. A user-friendly website with online booking capabilities is essential for converting leads into tenants. Local marketing efforts, such as partnerships with moving companies, real estate agents, and local businesses, can generate valuable referrals. Understanding the target demographic allows for tailored marketing messages that resonate with potential customers. Beyond initial tenant acquisition, strategies for maintaining high occupancy involve fostering tenant loyalty and encouraging long-term rentals. Offering competitive pricing, providing excellent customer service, and ensuring a clean, secure facility are fundamental. Referral programs, where existing tenants receive incentives for bringing in new customers, can be highly effective. Seasonal promotions and discounts can attract new renters during slower periods. Regularly monitoring market rates and adjusting pricing dynamically helps to optimize occupancy and revenue. A proactive and adaptive marketing strategy is vital for sustained success in a competitive market, ensuring a steady stream of new tenants while retaining existing ones. Technology in self-storage. Technology is rapidly transforming the self-storage industry, enhancing operational efficiency, security, and customer experience. Automated gate access systems, controlled via keypads or smartphone apps, provide tenants with convenient, secure entry while reducing the need for on-site staff. Advanced surveillance systems, including high-definition cameras and remote monitoring capabilities, offer enhanced security and peace of mind. Smart unit locks, accessible via mobile devices, provide individual unit security and allow for remote management of access. Embracing these technological advancements can significantly streamline operations and improve profitability. They also provide a competitive edge in attracting modern tenants. Property management software, PMS, is another cornerstone of modern self-storage operations, automating tasks such as online bookings, payment processing, lease management, and financial reporting. These systems provide comprehensive data analytics, enabling owners to make data-driven decisions regarding pricing, marketing, and operational adjustments. Kiosk systems allow for 24/7 self-service rentals, expanding accessibility and reducing labor costs. Integration of these technologies creates a seamless experience for both tenants and operators. Investing in the right technology infrastructure is crucial for staying competitive and maximizing the efficiency and profitability of a self-storage facility in today's market. Revenue management techniques. Effective revenue management is crucial for optimizing profitability in self-storage, moving beyond simple fixed pricing. Dynamic pricing strategies, which adjust rental rates based on demand, occupancy levels, and market conditions, allow facilities to maximize income. This involves using data analytics to understand peak seasons, local events, and competitor pricing. Implementing tiered pricing for different unit sizes, features, example, climate control, and lease terms can also capture a wider range of customers and optimize revenue per square foot. The goal is to fill units at the highest possible rate while maintaining a healthy occupancy. This strategic approach ensures the facility adapts to market fluctuations. Beyond initial rental rates, ancillary revenue streams significantly contribute to overall profitability. Selling packing supplies, such as boxes, tape, and locks, offers convenience to tenants and generates additional income. Offering tenant insurance, either directly or through a third-party provider, is another common and profitable service. Charging administrative fees for new leases, late payments, or lock cutting can also bolster revenue. Implementing a robust collections process for delinquent accounts is vital to minimize lost income. By strategically combining dynamic pricing with diverse ancillary services, self-storage investors can significantly enhance their facility's financial performance and achieve higher returns on investment. This holistic approach is key. Legal and regulatory considerations. Navigating the legal and regulatory landscape is a critical aspect of self-storage investing. Investors must be aware of local zoning laws, which dictate where facilities can be built, their size, and specific operational requirements. Building codes and fire safety regulations are also paramount, ensuring the facility meets all safety standards. Environmental regulations, particularly concerning stormwater management and hazardous materials, must be strictly adhered to during development and operation. Non-compliance with these regulations can lead to significant fines, delays, or even project abandonment. Thorough research and legal counsel are essential to mitigate these risks and ensure smooth operations. Tenant protection laws, including those related to lien rights, eviction procedures, and abandoned property, vary by state and locality and must be fully understood. Self-storage operators have specific rights to seize and sell contents of delinquent units, but these rights are strictly regulated to protect tenants. Lease agreements must be carefully drafted to comply with all relevant laws, clearly outlining terms, conditions, and tenant responsibilities. Insurance requirements covering property, liability, and potentially business interruption are also crucial. Staying informed about legal changes and maintaining proper documentation are vital for protecting the investment and avoiding costly legal disputes. Legal compliance is non-negotiable for long-term success. Risk assessment and mitigation. Investing in self-storage, like any real estate venture, involves inherent risks that must be carefully assessed and mitigated. Market saturation is a significant concern. An oversupply of units in a given area can lead to lower occupancy rates and reduced rental income. Economic downturns, while often less impactful than on other property types, can still affect demand and tenant ability to pay. Operational risks include property damage, theft, and inadequate security measures, which can lead to financial losses and reputational damage. Identifying these potential pitfalls early is crucial for developing robust mitigation strategies. A proactive approach to risk management is essential. Mitigation strategies involve diversifying your portfolio across different markets or facility types to reduce exposure to local economic fluctuations. Implementing robust security systems, including surveillance, access control, and insurance, helps protect against operational risks. Regular maintenance and property upgrades can prevent deferred maintenance issues and enhance tenant satisfaction. Financial planning should include contingency funds for unexpected expenses or periods of lower occupancy. Thorough due diligence, as discussed earlier, is the primary tool for identifying and avoiding many risks upfront. By systematically addressing these risks, investors can safeguard their assets and ensure the long-term viability of their self-storage investment. Exit strategies for investors. Having a clear exit strategy is as important as the initial investment decision in self-storage. One common strategy is to sell the stabilized asset to another investor, often a larger institutional buyer or a real estate investment trust, REIT, once the property has reached optimal occupancy and cash flow. This allows the initial investor to realize capital gains and redeploy capital into new opportunities. Timing the market is crucial for maximizing sale price, often aligning with periods of strong investor demand for self-storage assets. Preparing the property with updated financials and a strong tenant base will enhance its attractiveness to potential buyers. A well-executed sale can yield significant returns. Another exit strategy involves holding the property for long-term cash flow, leveraging its stable income stream and potential for continued appreciation. This approach is suitable for investors seeking passive income and long-term wealth accumulation. Refinancing the property, often through a cash-out refinance, can allow investors to extract equity while retaining ownership, providing capital for other investments or personal use. For a portfolio of facilities, a phased exit, selling properties individually over time, can optimize returns and manage market exposure. The choice of exit strategy depends on the investor's financial goals, market conditions, and the specific performance of the asset. Planning ahead ensures maximum flexibility and profitability. Developing new facilities. Ground-up development of new self-storage facilities offers significant opportunities for investors to create modern, purpose-built assets tailored to specific market demands. This process begins with meticulous site selection, considering factors like zoning, visibility, accessibility, and local demographics. Securing the appropriate land is followed by detailed architectural design, focusing on efficient layouts, diverse unit sizes, and modern amenities like climate control and advanced security. Navigating the permitting and approval process with local authorities can be complex and time-consuming, requiring careful planning and adherence to regulations. Successful development requires a strong project management team and a clear vision. Construction management is a critical phase, ensuring the project stays on schedule and within budget. This involves selecting reputable contractors, overseeing construction quality, and managing material procurement. Once construction is complete, the focus shifts to lease-up and stabilization, which involves aggressive marketing to achieve target occupancy rates. This initial period often requires significant capital for marketing and may have lower initial cash flows. However, a well-executed development can result in a state-of-the-art facility with higher potential for appreciation and long-term profitability. Understanding each stage of the development cycle is key to mitigating risks and maximizing returns. Converting existing properties into self-storage facilities can be a cost-effective alternative to ground-up development, particularly in urban or densely populated areas where land is scarce. Suitable properties often include vacant retail stores, defunct manufacturing plants, or large warehouses. The conversion process typically involves extensive structural assessment to ensure the building can support the new use and unit configurations. Repurposing existing structures can significantly reduce development timelines and construction costs compared to building from scratch. However, it also presents unique challenges related to building codes, environmental assessments, and the adaptability of the existing layout. Careful planning is essential for a successful conversion. Key considerations for conversion include the building's ceiling height, column spacing, and load-bearing capacity, which impact unit design and accessibility. The existing infrastructure, such as electrical and plumbing systems, must be evaluated for potential upgrades or modifications. Obtaining necessary zoning changes and building permits for the new use is a critical step, often requiring extensive negotiation with local authorities. Marketing the converted facility requires highlighting its unique features such as urban location or historical charm while emphasizing modern amenities. A successful conversion transforms an underutilized asset into a profitable self-storage operation, contributing to urban revitalization and meeting local storage demands efficiently. Environmental and zoning issues are significant hurdles in self-storage development and acquisition that require careful attention. Environmental due diligence, including Phase 1 and potentially Phase 2 environmental site assessments, is crucial to identify any contamination from previous uses. Contaminated sites can lead to costly remediation efforts and legal liabilities, making a thorough assessment indispensable. Compliance with stormwater management regulations, waste disposal guidelines, and air quality standards is also essential during both construction and operation. Ignoring these environmental considerations can result in severe penalties and project delays. Proactive engagement with environmental consultants is highly recommended. Zoning regulations dictate the permissible uses of land and the specific requirements for development, such as building height, setbacks, and parking ratios. Investors must verify that a proposed self-storage facility aligns with the current zoning, or be prepared to seek a zoning variance or rezone the property. This process can be lengthy and contentious, often involving public hearings and community opposition. Understanding local comprehensive plans and future land use designations is also critical to ensure long-term viability. Engaging with local planning departments and community stakeholders early in the process can help navigate these complexities and secure necessary approvals. Diligence in these areas prevents costly future problems. Advanced investment strategies. Beyond traditional acquisition and development, advanced investment strategies can unlock greater value in the self-storage sector. One such strategy is portfolio aggregation, where investors acquire multiple smaller facilities over time to create a larger, more valuable portfolio. This allows for economies of scale in management, marketing, and financing, often leading to higher overall returns. Another advanced approach involves specializing in a niche market, such as climate-controlled wine storage, high-security vault storage for valuables, or specialized business inventory storage. These niches can command premium rental rates and attract a dedicated clientele. These strategies often require deeper market insight and more sophisticated operational capabilities. Implementing value-add strategies on a larger scale is also an advanced approach. This could involve acquiring a portfolio of underperforming assets and systematically improving their operations, upgrading amenities, or expanding existing facilities. Strategic partnerships with experienced developers or operators can facilitate entry into these more complex ventures. Utilizing sophisticated data analytics and predictive modeling to identify emerging markets or undervalued assets is another advanced technique. These strategies typically involve higher capital commitments and greater risk, but offer the potential for significantly enhanced returns. Continuous learning and adaptation to market dynamics are crucial for success in advanced self-storage investing. Portfolio diversification. Diversifying a self-storage investment portfolio is a key strategy for mitigating risk and enhancing long-term returns. This can involve spreading investments across different geographical markets, reducing exposure to local economic downturns or oversupply issues in a single area. Investing in a mix of facility types, such as traditional drive-up, climate-controlled, and specialized storage, e.g. RV boat, also provides diversification, catering to varied tenant demands and market segments. A diversified portfolio is less susceptible to the underperformance of a single asset or market. This strategic allocation helps create a more resilient and stable investment profile, protecting against unforeseen challenges. Beyond property types and locations, diversification can also extend to the tenant mix, balancing individual renters with commercial clients. Commercial tenants often sign longer leases and provide more stable income, while individual renters offer flexibility. Diversifying across different investment structures, such as direct ownership, joint ventures, or real estate investment trusts, REITs focused on self-storage, can also spread risk and provide different levels of liquidity and management involvement. The goal of diversification is not just to minimize risk, but also to optimize the overall risk-adjusted returns of the portfolio. A well-diversified self-storage portfolio is better positioned to weather market fluctuations and achieve consistent growth over time. Tax implications of ownership. Understanding the tax implications of self-storage ownership is crucial for maximizing net returns and ensuring compliance. Depreciation is a significant tax benefit, allowing investors to deduct a portion of the property's value over its useful life, reducing taxable income. Interest payments on commercial mortgages are also typically tax-deductible. Property taxes, however, represent a significant ongoing expense that varies by location and can impact profitability. Investors must be aware of local property tax assessment methods and potential opportunities for appeal. Consulting with a qualified tax professional specializing in real estate is highly recommended to navigate these complexities and optimize tax strategies. When selling a self-storage facility, capital gains taxes will apply to the profit realized from the sale. However, investors can defer these taxes through a 1031 exchange, allowing them to reinvest sale proceeds into a like-kind property without immediate tax liability. This strategy is particularly valuable for long-term investors looking to grow their portfolio. Understanding state and local income taxes, as well as potential transfer taxes on sales, is also important. The legal structure of ownership, e.g., LLC, partnership, individual, can also have different tax consequences. Proactive tax planning is essential throughout the ownership cycle, from acquisition to disposition, to minimize liabilities and enhance overall investment performance. Future outlook for self-storage. The future outlook for self-storage investing remains largely positive, driven by ongoing demographic shifts, evolving consumer behaviors, and technological advancements. Urbanization and smaller living spaces continue to fuel demand in metropolitan areas, while suburban growth supports demand in surrounding communities. The rise of e-commerce and remote work also contributes to increased business storage needs. Creating a robust and diverse tenant base, innovation in facility design, such as multi-story buildings and automated operations, allows for more efficient land use and enhanced customer experience. These trends suggest sustained growth and resilience for the industry. Investors can anticipate continued opportunities for expansion and value creation. Technological integration will further shape the industry, with smart access systems, AI-driven pricing, and enhanced digital marketing becoming standard. Sustainability initiatives, including solar power and water conservation, are also gaining traction, offering long-term operational savings and appealing to environmentally conscious tenants. The industry is expected to continue its consolidation trend, with larger players acquiring smaller, independent facilities, creating opportunities for both sellers and buyers. Adapting to these evolving trends and embracing innovation will be key for investors seeking to capitalize on the long-term potential of self-storage. The sector's inherent stability and adaptability position it well for future success. Course summary and next steps. This course has provided a comprehensive overview of investing in self-storage facilities, covering essential topics from market analysis and property acquisition to management, financing, and exit strategies. We explored the unique advantages of this recession-resistant asset class, including its stable cash flow, lower operating expenses, and flexible lease terms. Understanding market trends, demographic shifts, and the various types of facilities is crucial for identifying profitable opportunities. We also delved into the importance of thorough due diligence, encompassing location, financial, environmental, and legal considerations to mitigate risks and ensure informed decision-making. The knowledge gained here forms a solid foundation for your investment journey. As you consider your next steps, remember that continuous learning and staying informed about industry developments are vital for long-term success. Consider networking with other self-storage investors, joining industry associations, and attending conferences to expand your knowledge and connections. Begin by researching specific markets that align with your investment goals and risk tolerance. Develop a detailed business plan, outlining your acquisition strategy, financing approach, and operational model. The self-storage industry offers diverse opportunities for both new and experienced investors, and with the right approach, it can be a highly rewarding venture. We encourage you to apply these principles diligently.